Okay, so briefly, I want to make sure to pick up a little bit where we were so that I can flow right into the stuff that I do think is going to be a little bit more difficult. Um, so, for the most part, we are lending long and borrowing short. So, I'm making a 10-year loan, but let's say I'm borrowing in a sequence of 6-month smaller loans. So I'm charging a higher rate that could be linked or tied to the 10-year treasury. All right. So I'm charging this long rate here, but I'm borrowing in these sequences of 1-year loans because I want this rate here. And that gap between it's a failure of the law of one price because it's the same $10,000 or the same $20,000. It's just that if you lend it for this period of time, it costs this much, or you'll yield this much. And if you make that loan for this amount of time, it's this much. So a much lower spread. So we want to make sure that we're creating an arbitrage opportunity, and when we create that arbitrage opportunity, the lender has to worry about a duration gap because they may owe these 1-year loans before the 10-year loan is repaid. So at least here you have a 7-year mortgage loan and you have a 1-year CD. So we have to worry about making sure uh, is there a way to close that gap a little bit? I mean, we certainly like money, but we also don't want to leave ourselves exposed to interest rate uh, risk. Uh, I don't know what you mean by it only accounts for expected inflation. The law of one price basically says if there's two prices for the same good or service for the same widget, then that's a failure of the law of one price. There should only be one price for the widget, and if I spread the yield curve, then there's two prices for the same widget. All right. No. Nope, nope, nope. Law of one price is simply just saying there shouldn't be two prices for the same thing. That's right. So with this duration gap that we get, all right, and that was when we were talking lending long and borrowing and sequences of short-term loans. We're going to switch to use derivatives to close that gap. But this is where we left off. We said that how do you price a loan? We started the risk-free rate, which would be that treasury yield curve. We go up and add for the risk of default. We add for the prepayment risk. We add a servicing fees. We add origination fees. And then we get the average percentage rate. A lot of people look at the rate and they ignore the fact that they're paying fees to the lender. But the reality of it is you have to look for both the rate and the fees when you're talking about what rate you got, because the fees can be either rolled into the loan or rolled into an upfront fee. And so we have a loan that has default and prepayment risk. So that's why the purple is going around it. It's got the red and the blue risks associated with it. And then we're lending long and borrowing short. So that's the funding risk. And then, of course, you have capital requirements, and you can have systemic risk panic on both sides of the balance sheet. So that's kind of where we're headed. So now what I want to do is I want to work a little bit backwards, because what we're going to do is we're still lending long and borrowing short. But what I want to do is maybe we're going to start off with repos and perhaps get a loan and fund it without deposits, or maybe when we switch over into a futures contract, we're going to lock in a short rate over a long period of time. So let's work backwards and talk about a house and pulling mortgage out of the house. Okay. So let's say that when you go and get a mortgage loan, let's say you buy a house, instead of paying cash for the house, you go and get a mortgage loan for that house. In effect, what you're doing is you're asking the lender to let you know how much would that lender, how much would you be able to pull out of that house in the form of liquid cash. And if you default on the house, on that cash loan, then the lender gets to keep the house. The lender can foreclose on the house. And once the lender obtains title to the house, then the lender can sell the house and recover what you defaulted on the loan. So in effect, what you're doing is you're making a spot sale and you're making a forward repurchase of your illiquid house. All right. So your house is the illiquid asset. You're kind of selling it to the lender when you take out a mortgage loan, but by paying off the mortgage loan, you're repurchasing the house. All right. And if you get a loan for less than the value of the house, we call that a haircut. All right. So, in effect, I want you to think in terms of this repo and this reverse repo transaction, the repo being from the homeowner's point of view and the reverse repo being from the lender's point of view. I want you to think about that when we get into the repos. The difference between the repo and what I just described with the homeowner is instead of a house here, we have an illiquid bond. So maybe we have an illiquid car loan. Maybe we have a small business loan. Maybe we have a mortgage-backed security. Maybe we have some kind of a security. It could even be a mortgage. Maybe I made a loan to someone to buy a house, and now I want to take that mortgage loan and get a repo from it. So all I'm doing is saying that I have an illiquid asset, and I want to take that illiquid asset and get a liquid loan, and I'm going to go to the repo market to do it. Okay, what's up, Will?
So
Go ahead.
when you say a forward resale is a reverse
Forward
repo,
repurchase.
or
hmm
so why is a reverse repo always a stream of repayment, or can it also be like a lump sum repayment?
For our purposes, we will treat it like a lump sum repayment, because if the bank is lending long and borrowing short, they're using a sequence of repos, and we're going to treat it as a zero coupon loan. So there's no coupons or interest payments in the middle. It's just that we're each sequence will be its own zero loan. Does that make sense?
Yeah, but so with this analogy of the cash out refinance, that's where that analogy sort of differs, correct?
It can. I mean, when if the loan has a coupon, we're gonna call that a convenience yield. So we're gonna work our way to it. But if I make you a loan and I'm using one of your loans as collateral, then if your loan pays a coupon, or if I was to use your stock and your stock paid a dividend, I might get to keep that dividend as a convenience shield just because I own the collateral while you own the loan. When you repay the loan, you get the collateral back and you get to keep any future convenience yields that it gives you.
May be able to keep it or always that convenience yield.
I will say may, because when
Okay.
you deal with derivatives, derivatives mean that you have a right to exercise and own it, but not always.
Okay.
So I'll say, depending upon how the transaction was done, If it was done such that you do own the collateral while the person has the loan, you definitely get to keep the yield. But if
Okay.
you have some kind of a derivative where you have a right to take possession of the collateral, but you don't quite own the collateral yet,
Gotcha.
then it's not it. So I guess in some ways you could say, even though you use your house as collateral, if you decide to rent it out and you collect rents on the house, you get to keep the rent because the lender may have rights to the collateral after you default on the loan. So I'm using the house analogy because I think it's more tangible. It makes more sense. But in reality, um, the
Not a
complicated, the contract can be as complicated as the parties want to
Okay.
make it.
So
All
that
right.
it's not a perfect
Hmm.
analogy. It's just
Right. That's
okay.
right.
Understood. Gotcha.
No problem. And Arthur, that's correct. It's like collateral. And James, the repo transaction has a due date, so it will be eventually paid off. And then you can re up. But the nice thing about it is it allows, if an illiquid asset does not sell that often, people don't sell their houses as quickly as stocks would trade, for example. Use the repo market allows us to figure out what the value of that illiquid asset is, even though that illiquid asset does not change hands that often. All right, so that's the beautiful. Not necessarily, no. If I'm using the mortgage to pay off the house, or if my house is paid off and I go get a mortgage so I can pull cash out, then that's the same. That's a very similar function to what the repo is. I can either get a repo because I am purchasing the asset, or I can own the asset but getting the repo because I want to get some cash. I need some temporary cash, and it's the same thing. I will say this: almost all lending requires collateral. Now, their credit cards, not necessarily. That can be an uncollateralized loan. But if you get a car loan, if you get a business loan, if you get a mortgage loan, most of the loans that you'll get uh, are going to be collateralized loans, and only a handful of loans that you get won't necessarily be uh, collateralized. They'll depend upon your anticipated cash flow. So we have underwriting for collateralized loans, and then we have cash flow underwriting. And cash flow underwriting seems to it's becoming a little bit more popular, but ultimately, um, cash flow if a bank makes a loan based on cash flow underwriting, then usually they try to get a guarantee from the federal government, like a small business loan, SBA, Small Business Administration, FHA. They always try to see if they can, if the borrower qualifies for some federal guarantee, because then the bank is going to be stuck holding the capital against that loan. So the bank definitely wants to do collateralized lending or get some kind of a federal guarantee. But okay, so now let's talk about a repo agreement. So it's keep that analogy in the back of your mind. I the guy it is just the guy giving the loan and getting the asset. All right, so the reverse repo is the guy giving the loan and getting the asset. All right. So let's say I'm a bank, okay, and I have on my balance sheet this loan right here that has default and prepayment risk, and I need some cash because Friday is coming and a lot of my depositors are going to come in and they're going to want to cash their paycheck and I need some cash money. What I will do is either I can go to the federal funds market and get a loan from some of my other bank buddies, but it's Friday and payday for them as well. So maybe I can go to the repo market, and what I'll do is I'll sell this loan to in the repo market with the promise to repurchase it. All right. And when I do that, I'll get a temporary cash loan. So it's a spot sale and a forward repurchase. I probably should have put this in purple of a bond asset that's used as collateral. Now, the cash loan is going to be less than the full value of the underlying collateral. All right. So if I don't pay the repo loan back, then the illiquid bond goes to the lender. The loan will also include a haircut depending upon how illiquid the asset is. If it's an asset that doesn't trade that frequently, then that means that the lender that owns it after I default is going to have a hard time selling that asset. So the more illiquid that asset is, then the bigger the haircut on that illiquid bond. So the assumption is that the asset that is being sold in the repo market is an illiquid asset, and you're promising to buy it back. All you want is a temporary cash loan. All right. And the borrower wants the collateral back. All right. And the lender, ironically, does not want the collateral. They just want to make some money by making a short term loan to someone that actually has the collateral. So it's a win win. Yeah, exactly. So the bigger the haircut, the larger the market failure. All right. So if it's a liquid market, then I should be able to get the value, I should get closer to the value of the collateral. But the more illiquid the market, and that's also a violation of the Black-Scholes, because the Black-Scholes assumes that the collateral should be the call and put options are priced on liquid collateral that imply volatility. All of those, we really, when we're doing microeconomics, especially when we're doing micro in the world of finance, one of the assumptions is perfect liquidity. And the perfect liquidity breaks down, and that means the price is not efficient. Remember, in microeconomics, we're studying efficient pricing. And so a market failure occurs when the price is not efficient, when the equilibrium price is not efficient. We want the equilibrium price to be both efficient, to be in equilibrium, meaning that no one in the market has an incentive to change their behavior. And we want that price to be efficient. It's the best price. There's no consumer or producer surplus. But if there's an illiquidity in there, then we're probably going to wind up with some kind of consumer or producer surplus. Something's not going to converge. So that's how we do micro and reverse engineer. So back to the convenience yield here. So the reverse repo, from the lender's point of view, I'm going to purchase that illiquid bond and then sell it back to the borrower. All right. And I'm going to use that as collateral for the cash loan. And if that collateral pays a coupon and I happen to own it, then that dividend, that coupon or that dividend is the convenience yield. I didn't do anything, but I just bought the collateral as a hedge just in case that bond, that short-term loan is not repaid. And don't forget, we use loan and bond interchangeably. So if I use a loan to get a loan, that means the loan that's being used as collateral is the illiquid loan. All right. So I'm trying to get a cash loan, but I'm going to use an illiquid loan for collateral. All right. So the lender wants to receive the yield from making the liquid loan and not take possession of the collateral. If I'm a lender, I don't necessarily want the more illiquid asset on my balance sheet. I just want to make a little money uh, uh, providing cash to someone who already has an illiquid asset on their balance sheet. Okay, so does that kind of make sense? Great. All right. Oops, let me see. I got a question. Okay, good. Good. All right. I'm toggling between screens. Okay. So we are facilitating liquidity for people that are holding illiquid assets. And because illiquid assets don't trade that often, we are providing a price discovery function. We're figuring out what the market is willing to pay for these illiquid assets that don't trade that often. Now, that's one of the roles of a derivative is to, is to for price discovery. Probably. Yeah, you can do multiple versions, but then, number one, the lender's going to ask if that loan is encumbered, meaning if there's other, if it's secured by other collateral. So uh, maybe it's possible, but given that the repo agreements are kind of short term, and a smart lender's going to check and make sure that there's some other collateral that can be used, because remember, the other person owned the collateral. So if I'm going to take the cash loan that I have and use it to someone else, then I better have some more collateral, or else I'm not, so um, you have to be careful. People have to be careful with that because they do want to get paid. All right, now the general collateral financing repo market. This is an important point. I don't know how much emphasis people put on that, but we do have a market that consists of just US Treasuries that have no embedded call or put option risk. There's no risk to pay early or risk to pay late, and we can use that as collateral. If you go out and buy US Treasuries, then you can use your US Treasuries as collateral for repo loans. And in that market, you don't have as many haircuts because the collateral is risk free, and you're not going to have a margin call. Usually, a margin call means that you've got to require pledge more collateral. You got to pledge a lot more than what your loan is worth, and you have to worry about, in some cases, like a mortgage loan, what happens if you get a repo and then your mortgage loan prepays because the borrower wants to refinance into a cheaper mortgage. Well, that pisses off the repo lender, so they may um, increase how much collateral you need for that short-term loan because they're worried that that loan is going to prepay, and then they're going to have made you a loan, but your collateral will have gone. So that can be a big problem um, for a lender. All right. Do you have any haircuts? You very little. Okay, I'll get to you in a second, Will. The hair, you may have a haircut, but very small haircut in the GCF market. In the non-GCF market, you're gonna have big haircuts, but not. If you have a haircut in the GCF market, it'll be a small haircut. Of course, if the Fed starts threatening to play around with interest rates, that may actually cause some haircuts. James, real quick, um, um, a repo loan is different from a consumer loan. All right. So the people usually getting a repo loan is a bank getting another bank. We're not talking about a consumer getting a credit card loan or a consumer getting a mortgage loan. We're talking about bank getting a repo loan using one of its illiquid loans as collateral. And generally speaking, paying a loan off early does not affect your consumer credit score, um, as long as you don't miss a payment. Missing a payment affects your credit score. But paying off the loan or paying the loan early does not affect your credit score. In fact, that'll help your credit score. Okay, Will, what's your question?
Um, in the case of a long-term asset bond being paid off early, what happens if it's like during the repo agreement?
Oh, if rates are anticipated to change, if Jerome Powell gets on there and says, you know what, I gotta, the economy's doing good, so I'm thinking about lowering interest rates. It's quite possible that your lender, if you're a bank and you got a repo loan, you might get what is called a margin call, and that margin call may tell you, if Jerome slashes rates, do you have another mortgage lined up, or go to the US Treasury market and use that as collateral, because US Treasuries do not prepay. They are risk free. So if you have a loan that you're using as collateral and it has an embedded call option, which is prepayment risk, you might get a phone call saying, go and get a treasury and let's replace the loan with prepayment risk, loan that has no prepayment risk. Does that help?
Yeah, but who gets, because the person who bought the loan in the repurchase agreement, they own the loan, so don't they get that whole amount that was prepaid? That the loan is paid off? Don't they have that money?
Well, now, your question was if I'm in the middle of the repo agreement, meaning that the repo has not been fully repaid, right?
Yeah.
I've taken the collateral, I've given it to another lender. That lender, uh, I still have 6 months to repay my repo loan. In month three, the repo lender is a little worried that the call option to prepay is going to go in the money if the Fed lowers rates, and that the homeowner is going to exercise their call option to refinance that mortgage, meaning they're going to retire the old mortgage at the higher rate and replace it with a new mortgage at the lower rate. So that's when they
Yeah.
exercise that option. So what he can do is say, you know, would you like to hurry this, terminate this repo agreement using this mortgage as collateral and maybe get a U.S. Treasury, or would you like to double up? Do you have another mortgage that you can use in case this one prepays?
So my question is when, like, if they repay, like, just for no
If
reason,
who
they just
repays?
decide, the person who, the homeowner in this situation, if the homeowner
Right.
just repays, like, they, no warning, no, there's no reason to think they would, but they repay anyway.
Mm-hmm.
The person who bought it in the repurchase agreement, they now have the loan paid off. They just have money now. They
No,
don't
no,
have
no, no,
anything,
no.
right?
Oh, I see what question you're asking. No, because uh, they they can make an agreement with the bank that they bought the mortgage from and say, um, Well, to be honest with you, before a borrower repays a loan, they're going to call the bank that they owe the mortgage to. So it's really
Okay.
going to be the person who got the loan that's going to call up the person, the repo lender, and say, hey, my client is going to prepay. So let me replace the collateral.
Okay.
All
All right.
right. So this doesn't happen without the person that the mortgage is owed to not finding it out. All
Okay.
right.
Yeah, that makes sense.
Okay. All right. Is that another question, or I got one
Yeah,
more?
yeah, just a quick question. So when it comes to prepayment, isn't that pretty unusual in a repo transaction?
In a repo transaction, but Will was asking about what happens if the borrower prepays a mortgage that is being used as collateral in a repo transaction.
Oh, I see.
Okay. All right. Cool. Cool. All righty. Okay. Great. So let's go back to my little slide here. This is good. This is good. Y'all are forcing me to articulate and really be and be very careful with how I'm saying stuff. That's good. All right. Now, I can take a sequence of repos and lock in the funding costs over the repo period, and that can help close my gap. So if, let's go back here. I'm lending long and borrowing short, and I realize that I've got a loan that's got a 7-year duration, and I have a sequence of 1-year loans, or I might even have one that's 5. Now, I can get one repo, let's say for 2 years, and use this 5-year CD as collateral, or I can get 7 repos. Now, either way, if I do that, because I want to kind of close that duration gap a little bit, then when I enter into these sequence of repo contracts, then these sequences are pretty much locking in the funding costs over the repo periods, and that's helping to close my gap. All right. And in particular, if I have some government securities, so let's go back to my balance sheet here. And let's see, did I have any? Okay, I got cash, business loan, mortgage loans. Okay, this balance sheet doesn't have any government securities. So maybe they'll use some business loans and do a sequence of 1-year locks, or maybe they'll do the mortgage loans. But again, with the mortgage loan, you got to worry about the embedded call option risk to prepay. But they try to figure out, what can I use as collateral for my repo over whatever period, so that in that way that I got a 4 years and I got 2 years. I kind of want to close that duration gap so that I'm not worried about funding risk, which is the risk that my funding costs increase over the period that I'm waiting to get repaid. All right. So I don't want interest rates, short-term interest rates, to go up too much over the period that I'm waiting to get repaid, because if that happens, then that's going to reduce my profits. So that's why they're using the repo market. So just to make sure that we're clear, I have duration here, and I got negative convexity. That means that interest rates might change. Short-term rates may change. That short-term loan that I have, I'm locking in that rate because short rates follow a random walk. So I want to use those repo agreements to lock in. It's like Southwest Airlines knows that come Christmas time, it's going to be a lot of people that want to fly planes and go to their destination to be with their families for Christmas or the holidays, whatever. So they're locking in and using a futures contract now to lock in the price of oil for the airplanes. Well, if I'm a bank and I'm lending long and borrowing short, I know I know that that short-term rates are going to move over the period that I'm waiting to get repaid for this loan. So I'm going to use the repos to close these duration gaps for me. Maybe I don't close it over the entire period because you have to pay the lock. Remember, I'm going to get a cash loan for less than what the collateral is valued at, and I might even take a haircut. So if I do that too much, that's going to eat in to the profits here from lending long and borrowing short. So, but I'm trying my best. If interest rates drop, I will have paid for a lock and I could have been having profits. Of course, if interest rates go up, I will have paid for a lock and it saves me some money. So again, I'm really trying to, I don't have a crystal ball. I don't know the future. I don't know if short rates are going to go up or go down or whatever. So maybe I'll lock for this period of time and see where I think interest rates are going. Then maybe I'll lock for a little more, or maybe I'll lock for a little more. But because I realized that short rates are going to follow a random walk, this green is going to follow a random walk over the life of the loan, having no lock really exposes me to a lot of risk. It could end great, it could end well, or it could end poorly, but I want to figure out what is the optimal amount of a lock or repo lock that I want to engage in so that I can make sure when I file my annual report and tell my shareholders that I'm paying attention to my duration gap, they can believe me. All right. Because banks have shareholders and they have to let the shareholders know how well they're managing their interest rate risk. That's part of being the bank. All right. Now, the other thing to keep in mind, to keep it clean, let's say that poo-poo is illiquid. Nobody wants it. But I can use a repo contract and then I can turn these illiquid assets on my balance sheet into something that's liquid and usable. All right. And just to recap, the cost of my loan is called the repo rate. The haircut is added to the repo rate depending upon how illiquid or how stinky the collateral is. All right. Now, the haircut also reflects speculation. All right. Now, in a perfectly liquid market, the haircut theoretically should be zero. That's theoretically what should happen. The convenience yield. If my asset pays a dividend, if it's a stock, if I'm borrowing, if I'm using a stock as collateral to get a cash loan, that stock may pay a dividend. If it's a coupon bond, so remember the coupon bond pays a coupon, whereas the zero doesn't necessarily pay a coupon. So the repo loan is more like a zero coupon bond. But let's say I use a coupon bond as collateral. If I use coupon bond as a collateral and the agreement is written in such a way that I actually own the collateral during the repo period, then I can collect that coupon as well. All right. So, and the difference, the net carry, all right, if there is no coupon, then it's just a repo. If there is a coupon, that offsets the cost of the zero. All right. So, what am I saying here? Higher liquidity premium haircut. You can have negative repo rates, and that's because the underlying collateral is special. All right, so I can talk about that later. That means that the the person holding the collateral is willing to give up the convenience yield because the collateral that they want is special. They only want a certain type of collateral. They don't want just any collateral. They want a specific collateral. And I think I asked you guys a question on that on the problem set. So you'll see a question of what that means. All right. Okay, so now I replaced one of the original slides with this slide because I kind of wanted to make a point, and the slide that I originally had was a bit convoluted, and I hope that this one is a little bit better. So let's talk about where we've been and make the same kind of comparisons. So in the first part of the course, we talked about put call parity. All right. And we had the stock minus the strike price is equal to the call minus put. All right. And well, I'm sorry, the futures is the call minus put, and the carry was the strike strike price. All right. Now, we said that if volatility was not constant, then put call parity would fail. All right. So we knew that the call or the put option or something was wrong if velocity was not constant. If we could not, let me go back up here. If we could not perfectly replicate, right, if this relationship didn't hold where we couldn't perfectly replicate this put call parity, one of the problems for that is we said there was, so you said the basis didn't hold, and we started talking about this volatility, implied volatility. It wasn't constant, and then that messed up our put call parity. We are essentially saying the same thing here. So we're just saying it with some different variables. So what we're doing here is it's an arbitrage equation, spot futures parity, just like put call parity for the stocks is an arbitrage equation. These are arbitrage equations. Only instead of implied volatility messing things up, we're going to have that haircut mess things up. So I'm going to multiply through by -1, and then we'll have, instead of spot minus future, we'll have future minus spot equals the carry. And so we'll have the cost of the repo minus the convenient yield, and theoretically, you know, I can say the percentage change in the bond price relative to the futures price should equal this difference, and the world should be happy. The law of one price holds. Can't we all just get along? And then we find out that that bond is illiquid, and so you have to have a haircut. So the basis is still defined the way we defined it before. The underlying asset and the futures, or the derivative, the asset and the derivative tied to the asset are not equal. All right. So therefore that error term is now positive. Up here the error term was equal to 0. But now when you have implied volatility or a haircut problem, then the underlying collateral is less liquid. And another way this can happen is, again, if the Fed changes rates, then the initial par rate isn't equal to the spot rate. So let's say you get a mortgage at let's say you get a mortgage at 6%. That's the initial par rate, and your coupon payments are fixed over the life of your mortgage. Now, the Fed, let's say they lower rates. We're coming out of an inflationary period, and now they're saying, okay, we can lower the rates. So the current spot rates, if they're lowered, mortgage rates may drop to 4%. Well, if the spot rate is no longer equal to the initial par rate, we're going to say that's kind of like negative convexity. So the optionality, that embedded call option, is certainly going to be in the money. All right. So as long as, and I apologize for flipping up and down, but I want you to see what I'm doing here. So as long as we were, let's look at this side, the embedded optionality, as long as we were at the money, the par was 6% and the spot was 6%, we were jumping up and down. As soon as the Fed lowers rates, we're now in the money to prepay and pay early. So the moneyness of the option went from either out of the money or at the money, and now the moneyness is in the money. All right. And that is the negative convexity that we're talking about. We were at the money and then we slid way to being in the money. And as a result of that, let me go back to my graph here. As a as a result of that, the spot rate is no longer equal to the par rate, and so our hedge no longer, the spot futures parity no longer holds. So when the spot rate is no longer equal to the par rate, that's almost as problematic as the collateral not being very liquid, if the collateral is illiquid. So again, in economics and finance, we tell you how the world should work. The world should arbitrage. And if we have arbitrage, the law of one price should hold. So James' question earlier was about, again, the law of one price. We're assuming arbitrage. And if people arbitrage, then the law of one price should hold until all profitable arbitrage opportunities disappear. So what happens is all of these equations that we teach you in economics should hold up, and the basis should be zero and all of that. When the basis is no longer zero, that's when the economist jumps in. And I think about it, having the detective is a good analogy, because now we're going to try to back out. We're going to try to investigate and figure out, why didn't the put call parity hold? Or why didn't the spot futures parity hold? What underlying assumption prevented us from arbitraging the way the arbitrage equations said the world should work? That's what we do as economists. All right. I got a question here. Should we attempt to calculate? No, just do the problems that I give you on the problem set. I'm not asking for a bucket of blood. But there you go. So we're gonna assume that the world arbitrages. When we don't see arbitrage, then we're gonna figure out what initial assumption did not hold. That's what economists do. Was it a regulation? Was it a margin call? Was it speculation? What was it that caused this not to hold? All right. So, oh, good. I'm going to give you an example right here about the failure to basis risk. That's coming up. All right. So let's first talk about traditional versus primary dealer banking. So we've been talking a lot about traditional banking, where you have sequences of shorter term repo transactions, and that's used to find long-term borrowing. And then we got to do a sequence to lock in the short rate, and that's a synthetic position. All right. So when a bank holds a loan, they have to worry that the interest rate that they made you the loan at is not going to be constant over time, so that the par isn't going to equal the spot rate. And then you got to worry about the embedded call and put option risks. You're going to borrow in the repo market to finance the asset, and then you're going to lock in the future rates. That's kind of like a summary of what we've been talking about so far. Now, likewise, let's say that the Fed wants to, do we want? No, we U.S. Treasury because the Fed can only buy those instruments in the secondary market. Okay. So a financial institution, Bank of America, can trade securities with the federal government. So they can trade securities with the U.S. Treasury. So they go and buy the asset from the U.S. Treasury and they face the basis risk. Then the primary dealer, Bank of America or whatever, they borrow in the repo market to finance the asset and they lock in that price, and then they deliver, they call up a bunch of secondary market investors, including the Federal Reserve, and then they deliver those treasuries that they've locked in the price to secondary market investors. All right. And so the Fed cannot buy directly from the Treasury because that would be monetizing the deficit. So they always buy, the Fed will buy those bonds from the primary market dealers. They are considered short-term financing from the point of view of the bank. All right. So don't confuse your perspective as a depositor with the bank's perspective of using your funds as a short-term loan. All right. So, okay, well, let me repeat this. What makes this section of the course hard is I'm teaching it from the perspective of the lender, not from the perspective of the depositor or a consumer borrower or business borrower. I'm teaching it from the perspective of the bank. And that's what makes it hard because you all aren't used to thinking like a banker. All right. So if I had enough deposits, I might not necessarily need to conduct repo trades. But a lot of times I conduct repo trades because I don't have enough deposits. Okay, Will, go for it.
I'm sorry, could you explain this second part right here? The trading, this second half of the slide.
Oh, the available for sale securities.
Yeah,
All
like
right.
what is happening here in this little graphic here? Like what's
Very
going on?
similar thing. It's just that the U.S. Treasury isn't buying it back from Bank of America. Instead of it's similar to a repo transaction where I go and get a loan from someone. They get to keep the collateral until I repay the loan. What's happening with primary dealer banking is the bank goes and buys the loan from the bond from the U.S. Treasury, but instead of selling it back, they sell it to the secondary market. So I just kind of want to I just want to get you to see that when we talk about traditional banking and they talk about repos, that you got that. But if you hear someone talking about dealer banking, then the dealer is making the market between two separate entities. The dealer doesn't necessarily intend to keep the illiquid collateral for its own portfolio. They are still hedging against the interest rate risk, but they are market making. They are buying the bond from one institution and then they're hedging their interest rate risk, and they are trying to find someone to sell those instruments to because they don't intend to keep it on their balance sheet for a long time. So banks not only make loans, but they also deal in securities markets. Does that make sense?
Kinda. Yeah. Kinda.
Okay.
Yeah.
Yeah. Banks deal in the bond. They are bond dealers, and not just U.S. Treasury bonds, but if we haven't talked that much yet about securitization, but they can sell a bunch of car loans and they can package it up and create securities, which we will talk about, and then they're selling the tranches of securities. And again, banks are as much bond dealers and loan dealers as they are loan originators. So that's actually the future to where we're going. All right. Let's take a deep breath here. It's only 8 o'clock. Now let's talk about what happened in March 2020. All right. So that's when, sorry about that, some light in the house is flashing. And um, damn, I'm in St. Louis. I'm not in my own house. So this is my parents' house. And now that they're no longer with us, I hope the house ain't haunted. I was a good son. All right. Could you re-explain the lender perspective again? Okay. How deposits are short term. All right, real quick, and then I'll come back to that. But again, banks lend long and borrow short. When you deposit money into the bank, you're making a short-term loan to the bank, and every month the bank is supposed to pay you some kind of return on your deposit or your checking account or your certificate of deposit. But in effect, you, from the consumer point of view, is you're looking at it as interest on your checking account or your savings account. The bank is looking at it as they're paying you um, a low amount. All right, they're paying you this amount for your checking and savings account. But if you were to go and ask the bank for a loan, they would charge you this amount. So what they pay depositors and what they charge borrowers higher, and then they pay depositors lower. So that's what we're saying. From the bank's point of view, you represent a short-term loan to them. All right. And that's the perspective that I don't think is clear. When folks take money in banking classes, always you have to really readjust your insight and focus from the point of view of if you were a bank to really get it. And I know that's hard to do given that you guys have never ran a bank before. So that's what's going on. Does that help? Oh, let me see what. No. Normally, the bank fixes it so that you are less likely to continuously withdraw your entire account. You know, they give you like options to pay your bills online. They do direct deposit for you. They provide all of these services so that way you have less and less incentive to pack up your checking account and run. If it was easy for you to do that, let me keep scrolling. If it was easy for you to do that, then the bank would be worried. But what the bank does instead is they try their best to make sure that you have a reason. If your paycheck is directly deposited in your checking account, and you're writing bills out of your checking account, then the idea of you falling below a certain threshold or whatever is greatly reduced. The probability of you having all of these gyrations in your checking account and savings account, it makes your checking and savings account a lot more predictable. And in fact, that's really one of the reasons why banks are still relevant. I know a lot of young folks, until they get their first job, they're messing around with PayPal and Venmo and all of that stuff. But once you start getting a paycheck, that employer is going to ask you, where do you want your direct deposit to go? All right, because we're going to pay you by direct deposit. And then if you have to pay your utilities and stuff like that, they're not going to want you to put cash in an envelope. All right, so you're going to have a bank to accept your funds electronically and to deliver your funds electronically. And that's when uh, the bank can count that you're not going to go through all of the rigmarole to keep changing accounts and jumping around from bank to bank to bank. That just takes too much effort. So they create transactions costs to keep you there. All right. So let's talk about a violation of spot parity. So up here, we were saying we got a violation. And so we're going to come here and see what happened in March 2020 in the repo market that caused the violations. All right. Yes. Yeah. So the answer to your question, James, is yes. They gotta. It's almost like get you in the store with the loss leader, and then you happen to buy other stuff when you go into the store. So if Giant or Safeway, like for Thanksgiving, if you spend $40, you can get a turkey for however many cents a pound it's going to be. Well, as soon as you get in the store and you spend $40 for the turkey, you're going to start spending a whole lot more stuff. So, yes, it's a loss leader, but that's to keep you in the store. All right. So, all right, let's see. Okay, cool. All right. So, when the Fed decided to raise hikes, all right, so we had literally had a zero Fed funds rate um, uh, for almost, oh, it's not showing on here because the 2008 recession isn't here. This is 2019. So we had the COVID. That's right. So after the COVID, this is my, this is the repo rates. All right, so the repo rates follow the Fed funds rate real closely. And in fact, the Fed has a tough time trying to control the repo rates and the Fed funds rate. But theoretically, the law of one price hold. The Fed funds rate is an uncollateralized loan for a bank from another bank. So Bank of America and Wells can make loans to each other without collateral in the Fed funds market. But if they make a repo loan to each other, one is the repo lender and one is the repo borrower, those loans have to have collateral. So a collateralized loan should have a lower interest rate because you got collateral than the Fed funds loan. So they should trade real close together. When the Fed implements monetary policy, they actually implement it through the repo market. They may occasionally do some Fed fund stuff, but generally speaking, the Fed uses the repo market to implement monetary policy. And so when the repo market goes out of control, the Fed has to go out of control. All right, they're always worried. So, anyways, they changed the Fed funds rate or the short-term rates, and what happened was the banks that were holding treasuries, they saw that when the Fed increased interest rates, the present value of the rates went down. All right. So I'm trying to think, what slide did we have where we said there's this inverse relationship between interest rates and yeah. So you see this equation here? When interest rates go up, the present value of the bond goes down. The coupon remains the same, but the present value of the bond goes down. All right. So the Fed hiked rates, the coupons were fixed, the present value went down. And so the same is true for US Treasuries because they don't prepay. And so if your treasuries are being used as collateral, and this is collateral, like I said, in the general collateral financing market, the GC repo market. So that's where that comes from. And again, my apologies for all the up and down, but I just want you to see that I'm where I'm getting this stuff from. This stuff isn't coming out the air. All right. So they were using treasuries as collateral in the GCF repo market. The Fed hikes rates and the present value comes down. Then, of course, you're going to get more margin calls. The other lender's going to say, hey, the Fed is messing around with interest rates. The present value of your collateral is dropping. So I either need a haircut or I need more margin call. And as a result of that, the repo markets increased. And when the repo markets increase and you're lending long and borrowing short, so the bank is up here lending long and borrowing short, and they wanted to lock in some of the funding costs. They found a hard time doing that because the repo rates kept changing. And even if the repo rate was virtually insane, they had a long lock in, they had to come up with a margin call. So when the Fed hiked those rates to fight inflation, and I told you, I kind of thought that the Fed hiked them too much because the inflation was being caused by aggregate supply shock, not an aggregate demand shock so much. That changed the moneyness of the options to buy treasuries. So you're seeing this stability. Now, of course, I just told you the treasuries are risk-free. So I probably shouldn't say moneyness of the options on treasuries, but it certainly changed the moneyness of options on mortgages. I don't. Oh, I should have said like Freddie and Fannie. Um, oh, I know what I was thinking there, but okay. So I haven't talked about Freddie Mac and Fannie Mae and Ginnie Mae and all those government entities where they do issue bonds that have prepayment risk on them. So apologies for that last statement. Just know this, that the repo market, all of a sudden, you see this this treasury trade seems to go south. All right, that's the value of the treasuries because the interest rates went up. So the value of the treasuries relative to their futures contract went down. And that caused a lot of chaos in the market. So forget about this last bullet point here. That would take a whole lecture for me to explain to you what I was thinking about, and I need to fix that. So apologies for that. All right. But this is what I'm saying. When the par rates and the spot rates, it's very hard for the Fed to implement monetary policy because the Fed is well aware that they can cause basis risk on the balance sheets of financial institutions. So when the Fed comes out, when Jerome gets out there and says, we are about to change rates, we're going to hint at a 25 basis points hike, or we're going to hint at a 50 basis point hike or drop or whatever. They are trying to tell banks, get your duration gap in order because we are going to change the rates, and that is going to change the value of all of your collateralized loans. All right. So that's why it's really important for the Fed to kind of like articulate, you know, um, why they're trying to change rates and say, well, we got the AD curve may be rising too much, so we got to pull the AD curve back. And in order to shift the aggregate demand curve backwards, then we're going to start messing around with the repo rates and the Fed funds rate. Get your duration gap in order. All right. That's kind of what they're trying to convey. And when we saw Signature Bank and Silicon Valley Bank, those were relatively small banks, but they were holding a lot of US treasuries, and those treasuries lost value. And as a result of that, there was a panic that ensued, which shouldn't have ensued. And that was because of TikTok and some I forgot his name, but some well-renowned trader gets on there and scares everybody to death. So they start pulling their common shares and their deposits out of those banks. And so then the federal government wound up having to shut that bank down because of speculation, not necessarily on the fundamentals of that bank. So that happened uh, March 2020 and around 2022. I know I wrote a report on that for for Congress, so I'd have to find that for you. But that's when the Fed can actually cause uh, the spot futures parity not to hold. We do have a problem with the basis risk coming apart. All right. So let's see. Is it 8? Oh, it's 8:30. Let me cover this. I'll take some questions and then I might do the interest rate swap next week, only because I kind of feel like you all have been drinking out of a fire hydrant. I appreciate you all sticking with me and absorbing and asking questions. I really do. I just want to, I think we're in a good place and I don't want to kill it. So let me just go over this one slide and take some more questions, and then we'll see how we want to go from here. Because it's really only 8. I hate to not take advantage of the time while we have it, but okay. So let's say I'm a bank and I got these loans on the balance sheet. Maybe what I want to do is have the ability to keep a loan on my balance sheet or take it off. All right. So what I may do is enter into a futures contract so that if this treasury, if the Fed decides to hike rates and the present value of this entire loan goes down, I want to exercise my option to sell this loan and put it on someone else. So instead of Black-Scholes, we have Black's model, where the bank guessed incorrectly about what was going to happen to interest rates. But what the bank decided to do was, rather than lock into a rate using the repo markets, how about we just go and we get a future option where I can price the call, price the put. Here's my spot futures parity, and this was Black of Black-Scholes. Black passed away, and Myron Scholes is still alive. In fact, I met him at a conference. That was kind of cool. But anyways, Black has passed away. Scholes and Merton are still alive. All right. And this is the formula I want you to use. I think in problem set 2, there is a question. I want to say it's number 6. I can't remember right now, but I want you to use this model and I want you to subtract off the coupon. That's what this is. This is the coupon. So this is the bond. This is the coupon. And you're taking the futures contract and you're discounting it. You're finding D1, you're finding D2, then you find the call and the put option. And if you have an incorrect interest rate outlook, then you can exercise the call to either buy a bond that's going to be profitable at the lower price, or you can sell a bond that's lost value and put that on someone else. All right. So conceptually, we're doing the exact same thing, only we're doing it with futures options, and we were doing it with the stock. All right. Let me see my questions. Yes. Correct, James. Yes. So at any rate, I don't want you to feel as though you are constantly reinventing the wheel. We are taking the concepts that we learned in the first half of the course and we are applying them here. All right. Not only that, in the first half of the course, just to refresh your memories, we did talk about basis trades up here. We did talk about present value with the futures contract. We did talk about basis trades, just like you're selling your illiquid bond and buying a futures contract to repurchase it. This is exactly the repo agreement right here. All right. So I don't want you, and this is the reverse repo agreement. I don't want you to feel as though everything that you're learning, and we want everything to converge, but the convergence doesn't take place if we have implied volatility, a haircut, if the par is no longer equal to the spot. The illiquidity has to do with the volatility and the skew and the volatility smile. So we're just taking the same concepts that we've learned previously, and after we learned some mechanics about bonds, we're applying those same mechanics, talking about embedded optionality. We are talking about um, um, convex. Here we're talking about gamma risk. We're talking about delta over here. We're talking about gamma risk here and convexity. So I know that we're calling it different names, but conceptually it's the same thing. And here this is kind of new. I'm teaching you how to price a bond, and I'm also teaching you how banks lend long and borrow short. So instead of arbitraging to where profits go to zero, a bank opens up an arbitrage opportunity for itself. But when it opens up that arbitrage opportunity for itself, then it's got to deal with the risk of a duration gap. All right. And so you're seeing how they can use repos to fund that loan and lock in the lower rate. And you're seeing how they can use the repo market also to figure out the value of their illiquid assets rather than have that illiquid asset just sit on the balance sheet and do nothing for you. I can go and get a short-term loans using that illiquid asset or a sequence of short-term loans, and then I can see for each sequence how the asset values are changing over time. We're still using the same arbitrage equations that we used before. And again, we're reverse engineering. When the arbitrage equations don't hold, we are reverse engineering and trying to figure out what's wrong, what assumptions failed. Just explained when we're actually getting the loan to fund our balance sheet versus when we're dealing and we're just the intermediary guy. We are buying one in one market and selling it in another market. And I'm showing you an example of when I probably could have reversed these slides, where I'm showing you again where spot futures parity fails. All right. So that was that. And then I'm saying if our interest rate expectations are wrong, we can actually use derivatives, and the bond becomes kind of like the asset that we can either purchase using a call option or sell using a put option. All right. So, and what I can do is give you a chance to read it, but we can talk about interest rate swaps. where this is the call option formula, and this is the put option formula. What we're doing is we're locking in at the, and I'll go over this again next week, but what we're doing is the same thing that we did up here when we arranged the spot contract, is we are locking, where is this at? That's too far. Yeah, we are, maybe this is what I want. Yeah, right here. So we have a spot ceiling and a spot floor, and that's creating us a long futures contract, and a series of long futures contract we're calling a swap. So this here is page 23. When we go all the way down to page, what page is this? 52. If you notice, we have the ceiling and the floor is really the strike price. So we have the spot minus the strike. So that's the call option. And then we have the strike minus the spot, which is the put option. And so we are creating a futures contract, and the sequence of futures contracts is our swap. And when we talk about interest rate swaps, a bank can not only use the repo market and lock in a futures contract, but they can lock into a series of futures contracts, and they call it a swap contract. So I will explain that and go over that in more detail next week. And after we do the swap contracts, we'll do the credit default swaps. And essentially what we're doing is we're coming here to the balance sheet. Yeah, we're coming here to the balance sheet. I'm using the interest rate swap to lock in my funding risk, and I'm using the credit default swap to sell off my default risk. All right, so credit default swaps, banks use those to sell default risk, and insurance companies can use credit default swaps to buy default risk. And then we can also use interest rate swaps. So the credit default swaps are different from interest rate swaps. The interest rate swaps are being used to manage the duration gap and to lock in sequences of short-term rates so that I can lend long and borrow short, and then I don't have to really worry about short rates moving around on me. So banks use swaps all the time. And again, swaps are just sequences of futures contracts. So I just want you to understand, how does a bank price a loan? How does a bank fund a loan? And then how does a bank hedge against interest rate risk or funding risk? And how does it hedge against default risk? After that, and how they can use options to buy and sell items on and off its balance sheet. That's what these options are for. After that, you should have a pretty decent understanding conceptually of money and banking on steroids. All right. So now, if you all are still awake out there, are there any questions right now? James? I'm sorry, I'm not. Okay. Wow. All right. Well, okay. Well, now listen. You all should start working on those problem sets right now. Oh, that's not a good sign if you don't know what to ask. All right, so start working in your groups on those problem sets. Don't wait until the night before to start asking these questions, because I can assure you this is unfamiliar to you, even though I'm still using the same concepts that I've taught you before. All right. So no. Problem set due. We got one more lecture, right? I don't have my calendar. This is lecture number 2. We got one more lecture next week online. And then, yeah. And then when we return, let's do it 7 o'clock. No problem. Just you scaring me because I don't have time to grade them this week. I got to drive back to Maryland. So yeah. Yeah, but start them now. Don't wait till the last minute. You all need to start teaching the material to each other. Just the reason I know it is because I teach it. If I didn't teach it, I would be looking stuff up and I'd be fumbling and all of that. But after teaching it, it's finally clicked and set into my head, and it'll do the same for you once you start explaining it to each other. And don't just assign a problem to someone and then you don't look at it. You assign the problem to someone and ask that person to teach it to you, and then you repeat it back to that person. And that's how you all can really study and understand this stuff. If you're not writing it down, if you're not taking notes off the slides, and you're not articulating it to each other, you're not really learning it. You're just taking a glance at a slide and then thinking you can walk in and take an exam. That's not how this works. You have to be actively engaged, and don't wait until the last minute to be actively engaged. This stuff is not easy. And for those of you studying for licenses and stuff like that, yeah, you can memorize and regurgitate, or you can take time now when it's not costing you the license to really understand all of the different connections and how one theory with the stocks links into the theory with the bonds, and one concept is similar to this other concept. Learn that here. And then I'm not telling you not to memorize and dump for all those licenses and stuff that you have to take. But I am telling you that now's the time when you can start making all of these useful connections, and that will make memorization easier, because if you understand the concept, you don't have to memorize as much. All right. So start working together. Feel free to ask questions. Uh, um, I'm still going to try to give you 24-hour turnover when you send a question my way. I'll do the best I can, but I'm still, I want you all to succeed. I'm not trying to make it hard, but y'all can't wait till the last minute to do this stuff and then wonder what's going on. All right. So if there's no more questions, or if someone wants me to hang around afterwards, I'm happy to do that. But how about we uh, just, for those that want to stick around, and I'll just answer the questions for the people who want to stick around. All right, go ahead, Trent.
Hello,
How you doing?
I'm doing well. How are you?
There you go. I'm motivated. There you go.
I'm glad to hear that.
There you go. What's going on?
I suppose my question is this whole thing with the repo market. I'm still not sure what repo means.
Repurchase. Repo is short for repurchase agreement. It's an agreement to sell you something and buy it back, because it's an illiquid asset and you don't want it. Is that
And what's the point of this?
well, the point of it is to get a cash loan. So basically, I have an illiquid asset that's hard for me to sell, but maybe I can use the value of that. Where is it? Yeah, maybe I can use. So, like, let's say I have a house, it's illiquid. If I tried to sell a house, it might sit on the market for 3 or 4 months, but I need a cash loan to pay for, you know, to uh, pay for tuition, or buy a used car or something right away. So rather than sell the house outright, I can use the value of the house to get a cash loan because I need liquid cash right now. So technically, what I do is I pretend to sell the house to the lender with a promise to buy it back because the lender doesn't want a house. The lender just wants to make a loan to me, but the lender wants the loan to be collateralized by the house so that if the house if I fail to repay the loan, then the lender can initiate foreclosure and take the house. Likewise, in the repo market, I am a bank and I may have a cash loan. Where am I? Yeah. I may have a cash loan on my an illiquid loan on my balance sheet. And like I say, payday is Friday. So I need some cash money so that when people come into the bank, I can cash their checks. So I'll go into the repo market and I'll get a cash loan that's not the entire value of this illiquid asset, but of a smaller fraction. But technically, what I'm doing is I'm selling this asset to some other financial institution with an agreement to buy it back in exchange for a cash loan. Does that make sense?
And who most often would be using these sorts of loans?
Banks can get into these loans and get into them with insurance companies. They can get into them with securities dealers. They can get into them with the private sector, pension funds. They can get into them with college endowment funds. So they can, it's a whole lot of non-bank financial institutions that will glad to enter into repo agreements with a bank and vice versa.
Okay, cool. Thank you.
Cool.